So let's talk about the different kinds of investments that we can have. Now, this talks about how much stock you own in a company. So it all is dependent upon how much stock I own in a company. So I could own 0 to 20%. That's called the cost method or marketable securities. I could own 20 to 50%. That's called the equity method, also known the one-line consolidation. I could have 50% plus. That is called consolidations. So it all depends how much stock I own in the company. Because depending upon how much stock I own, that tells us how we're going to account for the investment. All right. Now, if it's 0 to 20%, that's called cost or marketable securities. If it's 20 to 50, it's called the equity method, which is kind of like consolidating, but you don't actually break out the detail. You consolidate in one line item called investment. Finally, if it's 50 or more, because I control you, we're going to consolidate and put our books and records together as if we're one company. So if it's 0 to 20, 20 to 50, the two people are called investor and investee. If it's 50% or more, they used to be called parent and subsidiary. Then FASB 141 said instead of parent and subsidiary, we'll call it acquirer and acquiree. Acquirer, acquiree. So acquirer, that's the old parent. Acquiree, that's the old subsidiary. Acquirer, acquiree. All right, so we have acquirer, acquiree. Now, well, actually, no, it's backwards. But when we look at acquirer, acquiree, we have this person acquiring and the acquiree being acquired. Parent, sub. Now, in looking at this, we're looking at how much stock you own. In all these cases, your journal entry is debit investment and credit cash. Now, under 0 to 20, at the end of the year, you still have an investment. Under 20 to 50, at the end of the year, you still have an investment. Under 50 or more, you cannot have an investment in yourself. So the process of closing out the investment is called what? Consolidations. So what we have to look at is how much stock do you own in the company? Because it all depends on how much influence you have over the company. So let's say, for example, I own 100 shares of whatever, of Apple. So I have 100 shares of Apple. Or let's say 100 shares of Microsoft. Now, do I have any real influence over the company? No, there's billions of shares outstanding. So I have 100 shares. I'm a nobody. I have no influence over the company. That's 0 to 20%. That's called cost or marketable securities. Now, the reason we account for these as follows is this. The way a corporation is set up, here's what we call the board of directors. Now, the board of directors, they have to act as a board, as a group. What is their job? One of the things they do is they hire the management or the officers of the company. Remember earlier, whose statements are these? Management, they run the day-to-day operations. They also declare a dividend. They also buy back treasury stock. So these are some of the things that the board does. Now, the board hires management. The management runs the company for the owners of the company. Who owns this company? Shareholders, stockholders. The stockholders get to vote in the board of directors. So I own 100 shares of stock. I get to vote in the board. The board gets to hire the management. The management runs the company for me. So the question is, how much influence do I have over the management? See what I'm saying? I don't directly vote them in. I vote the board in. The board hires them. So the question is, how much influence do I have over the board, which therefore is the management? If I own 100 shares of Microsoft and I call up the company, hello, Microsoft? Hi, I'm one of the owners of Microsoft. My name's Philipp. Hi, how many shares do you own? I own 100 shares. They hang up on me. I'm a nobody. If I own 20 to 50%, that's what? The equity method. Bill Gates owns, let's say, 30% of Microsoft. Do we know who he is? $60, $70 billion we know who he is. So when he calls up, they go, oh, yes, Mr. Gates. So they know who he is. Therefore, he owns enough. Therefore, the board knows who he is. Therefore, he has significant voting influence over the management. Because if Bill doesn't like the president, what does he do? He can't fire him, but he goes to the board meeting and says, hey, I don't like the president. And she goes, well, I like the president because it's my daughter-in-law. And I go, fine, I'll vote you out, put you in, who will fire them. So I don't control them, but I have a lot of influence. Versus if I have 50% or more, I control them, we consolidate. So that's why we look at how we account for these. So if it's 0 to 20, it's cost or marketable securities. 20 to 50, it's equity. 50 or more, consolidations. Now, in all cases, I'm buying the investment, debit investment. At the end of the year, here, you can still have an investment. Here, still have an investment. Here, cannot have an investment in yourself. Close it out. That's called consolidations.